The broadcast is now starting. All attendees are in listen-only mode.
Hello, and welcome to today's webinar covering the latest market trends and issues in the ports and terminal sector. My name is Dinesh Sharma. I'm joined today by my colleagues Eleanor Hadland and Eirik Hooper from our Ports and Terminals research team. Thank you very much for joining this webinar today. It'll take us about 20 minutes to go through the slides, after which there will be a Q&A session. If you would like to ask a question at any point of time, please do so via the questions panel on the screen. You can do this at any point during the webinar. We will aim to answer as many questions as we can at the end. However, those questions that we are not able to answer, we will respond by email. We will, of course, be sending out the presentation, a recording of the presentation, and a copy of the slides to all registered participants. I will now hand over to Eirik to start the presentation.
Thanks, Dinesh, and good afternoon to you all, and thank you all for joining today. The agenda for today's presentation provides selected highlights from our recently published Ports and Terminals Insight Report. So the agenda is, first of all, to go through the spotlight piece, which was easier to buy than build, then a Global Ports Monitor, followed by financial performance, deals and developments, conclusions, and finally through to the Q&A. The principal source for material for this webinar is the Ports and Terminals Insight Report that was published in May. This is available via the website as an annual subscription, which includes a quarterly report and a monthly data supplement. This monthly supplement provides timely insight into global and regional port performance trends, drawing extensively on Drewry's proprietary AIS-driven analytics model, which covers more than 200 of the world's top ports. Let's make a start by taking a look at some of the changes in the underlying dynamics of the container terminal market over the last few decades. The 90s and noughties saw the container trade grow at double-digit rates for much of that period, often 4 to 5 times global GDP growth, spurred on by the information revolution and increasingly open trade conditions. Most significantly, of course, was China joining the WTO in 2001. There was container penetration with investments into supply chains enabling the container trade to move into new markets, and containerization, or cargo conversion, where cargo that was previously carried as bulk or break bulk was put into containers. Post the global financial crisis, the industry moved into new territory, with swiftly falling growth rates and increasingly scarce and expensive opportunities for rapid portfolio expansion. This led on to the current post-pandemic world, with container trade growth forecast to grow roughly in line with global GDP growth between 1.5 and 2.7% from 2025 through to 2030. So the first stage of that life cycle, the 90s, we saw the few early movers and shakers in the terminal industry able to leverage their advantages in the initial period to build global portfolios that simply cannot be replicated today using the same strategies. The availability of new container terminals, especially in developed markets, as publicly owned ports with the concessionaire model, started something of a land grab amongst the now global container terminal operators. Early industry leader Hutchison grew at over 20% per annum for nearly a decade, expanding to rapidly to handle 13.3% of global trade by 2002. The first shock to the market came in the mid-noughts, with DP World acquiring CSX World Terminals, followed by the acquisition of P&O Ports. And then this was followed by PSA purchasing a 20% stake in then industry leader Hutchison. The size and scale of these deals would not be seen again for nearly 20 years, as the 2010s largely saw institutional investors flood into the market, especially in the more mature economies. These financial giants, with their enormous balance sheets and low cost of capital, were hunting for the strong and stable cash flows generated in the container terminal industry, and GTOs were largely happy to monetize some of their assets to free up capital to invest in further portfolio expansion. Since the global pandemic, the industry has shifted once again. This time, the extraordinary profits earned by the carriers has enabled a new round of portfolio expansion, largely by hybrid operators supporting their core line of business through targeted M&A activities. Between 2019 and 2023, MSC and CMA in particular have grown their portfolios at 3 times the average rate of the industry, moving up the GTO league tables as they have also moved up in the liner capacity rankings. While CMA and Hapag-Lloyd are worthy of mention for their strong acquisition pipeline, these appear tiny by comparison to MSC's gargantuan bets on the industry rather. Announcing 4 big acquisitions over the last 4 years and a cumulative investment of roughly $30 billion, MSC's audacious approach has seen it effectively buy terminal capacity in markets that would simply be unavailable by any other strategy. The breadth and depth of the portfolios of AGL, formerly Africa, Bolloré Africa Logistics, Hamburg's HHLA, Brazil's Wilson Sons, and Hutchison Ports took decades to build up. These deals have given MSC key gateway capacity in some of the most interesting container markets in the world. The AGL deal brought 16 container terminals highly focused in West Africa, with 13 terminals in 12 countries stretching from Senegal in the north to the Republic of Congo in the south. AGL also has a broad logistics footprint throughout Africa, including 250 logistics and maritime agencies and 66 dry ports. The Hala deal not only brings significant capacity in one of the most important ports in North Europe, but also a highly complementary intermodal logistics network operated by its Metrans subsidiary. Metrans operates 20 intermodal terminals and dispatches around 650 trains per week, focused on Central Europe origin destination cargo. So there's a good fit between MSC's Medlog rail operations, which are stronger in Western Europe, and Hala's Metrans business, with its focus on those CEE markets. But the big deal is the TIL BlackRock bid to acquire all Hutchison Ports Holdings non-Chinese assets for $22.8 billion. This deal encompasses 43 terminals, comprising 199 berths in 23 countries. The Hutchison assets contemplated by the deal would bring nearly 74 million TEU capacity to the MSC, TIL, AGL, Hala portfolio, bringing the cumulative total to a staggering 196 million TEU based on 2023 terminal capacity data, nearly double the pre-AGL MSC portfolio total. This would mean that MSC and its subsidiaries and affiliates have equity interest in over 15% of global terminal capacity, but more importantly, it gives MSC carrier-owned capacity in primary ports in some critical markets, including both coasts of Panama, both coasts of Mexico in the Americas, the UK, Netherlands, and Spain in Europe, Egypt, Oman, and Pakistan in the Middle East and South Asia, and Thailand, Malaysia, and Indonesia in Southeast Asia. These acquisitions would see MSC leapfrog from 7th to 1st place in Drewry's equity adjusted throughput league table, based on 2023 data. I must point out that while it's unlikely that MSC TIL will be allowed to take over all of Hutchison's assets due to market concentration concerns from the relevant competition authorities, it's also unlikely that this would make a large enough dent in the combined portfolio to affect this final outcome of going up to 1st place in the rankings. This also means that for the first time, 3 hybrid operators are represented in the top 5 GTOs. These 3 operators are also amongst the top 4 liner carriers by fleet capacity, which begs the question whether truly independent global terminal operators are still able to compete with the global hybrid operators when it comes to portfolio capacity expansion. I'm sure this is a question we'll come back to again in the future, but for now, I'll hand over to Eleanor, who'll provide a summary of the performance and outlook for the market.
Thanks, Eirik. I think you're definitely right that we're going to be talking about this deal for at least a year, if not longer, while it makes its way through regulatory approvals. So as Eirik says, I'm now going to take you through the performance of the global ports market. So outside of the Hutchison deal, we've been keeping our watching brief on the global container market. And at a global level, the rolling 4-quarter growth rate moderated slightly in the first quarter of 2025, dropping down to 5.8% from the fourth quarter reading of 6.2%. Drewry's downgraded its demand forecast for 2025, and we expect this growth rate, therefore, to slow further in the second quarter of 2025. There remains considerable variation, though, in throughput growth between regions. We've seen strong growth in Greater China, where the rolling 4-quarter growth rate held reasonably firm at 5.9% in the first quarter, just down marginally from 6.2% in the fourth quarter of 24. And in particular, we saw strong year-on-year performance at ports such as Shenzhen, where first quarter throughput was up by over 17%, Ningbo, where volumes rose by more than 10%, and Shanghai, where volumes were up 6%. But reports from China indicate that this was in part driven by front-loading of cargo in advance of the expected introduction of new tariffs by the US government. Unsurprisingly, we also saw pretty buoyant growth rates in North America, the rolling 4-quarter growth rate of 9.9% in the first quarter, again slightly down from the 11% that we saw in the fourth quarter of 24. And again, front-loading of cargo has been a key factor in these rather large growth rates. Early indications are that the market will experience a steep slowdown in May due to carriers having cancelled sailings in response to plummeting demand caused by the Liberation Day tariffs. But a 90-day respite was announced in mid-May that lowered tariffs from 125% to 30%. Reports indicated this in turn triggered a temporary cargo surge as importers took advantage of this window of opportunity. And news coming out of the market at the moment is there may well be an agreement before this window closes. However, it's fair to say, I think, that US West Coast ports in particular are going to be on a bit of a roller coaster ride when it comes to cargo volumes during 2025. What's the outlook then for the rest of the year? Now, our latest forecast was published in our Container Forecaster report in May 2025. There will be another edition of this report with another updated forecast out later this month. So the key uncertainty here is tariffs and the US and therefore global economy. So the tariff announcement back in April led most economists to revisit their forecasts for the year. The IMF downgraded its GDP outlook for the US in 25 to 1.8%. That's down 0.9 percentage points from its January forecast of 2.7%. And the world outlook for this year was also shrunk from 3.3% to 2.8%. Now, this lurch towards protectionism is expected to greatly reduce international trade's contribution to GDP, which will squeeze the GDP to container trade multiplier in very quick order. The WTO expects that world merchandise trade will contract by 0.2% this year under current conditions. Now, Drewry relies heavily on these third-party economic inputs for modelling global and regional container handling. And we now expect global container handling to decrease 1% in 2025. And that's the same level of contraction that the market saw in 2020 during COVID. And it would only be the third year with an annual decline since we started recording this data in 1979. For North America, we predict a substantial decline of 5.5% this year and a further loss of 4.6% in 2026. But the news keeps changing, so we are expecting to adjust these forecasts as some degree of certainty or on the latest news out of the US in respect of tariffs. Greater China, to the same end, will suffer too. Our revised 2025 outlook is for minus 4.8% growth, although we now expect this region to get back onto the growth track much sooner as it finds new markets with positive growth predicted for 2026. Overall, I think all we can do is express sympathy with ports executives and the rest of the supply chain that are trying to map out the game plan for a Trump 2.0 administration. There really are few, if any, upsides for container shipping from this trade war. but it must be noted that these tariffs can just as easily be withdrawn, and that could reverse much of the predicted damage. Drewry also monitors global port utilisation and forecasts this over a 5-year period. Now, global container port capacity is projected to grow at an average annual rate of 2.1% between 2024 and 29 to reach 1.48 billion TEU by 2029. That's an additional 145 million TEU of capacity coming on stream over the next 5 years. Our downgraded demand outlook has led to a reduction in the outlook for global utilisation, which is expected to drop below 65% in 2026, but then recover up to just below 68% by 2029. As with demand, there's considerable regional variation, with utilisation expected to remain high in the Greater China market, although here we do see additional capacity coming online, with a new terminal in Yantian scheduled to open later this year, and the good news that Shanghai International Ports Group has announced that it's finally moving forwards with the next phase of development at Yangshan Port, where it's going to construct an additional 6 kilometres, yes, you heard that right, 6 kilometres of berth over the next 6 years or so to handle deep sea cargo movements. We're also seeing major investments in Malaysian ports, with Tanjung Pelepas increasing its capacity to handle increased volumes arising from the Gemini Cooperation's selection of the port as a hub for its new network in Southeast Asia. And dredging and reclamation works are also underway at Port Klang, where Westports has commenced construction of CT10. We're also tracking connectivity in our quarterly report, and we have an index where we rank ports according not just to the number of scheduled weekly services, but also the regional breadth of these services. So when we look at the 20 ports that record the highest connectivity scores, we can see that while the rankings remain stable at the top of the table, there's more volatility as we move down the rankings. I think one of the things to note is how Hong Kong has been dropping further and further down the rankings. In the last year, it dropped 3 places. And this is in the face of stronger competition from mainland China ports. So at the same time, we've seen the Chinese port of Guangzhou move further up the rankings. Also one to highlight is how well South Asian ports have been doing over the past year. Colombo has benefited from the Red Sea crisis. Its location has been particularly good for vessels diverting on the Cape of Good Hope routings. But importantly, JMPT and Mundra have steadily increased the number of direct calls, with strong growth in particular on the Asia-South Asia trade lane. Looking now at the financial performance. We introduced the Drewry Global Container Terminal Revenue Cost and Earning Indices about 2 to 3 years ago now. In each quarter, we publish an update, and these provide a useful barometer of financial performance trends for the sector. In the first quarter of 2025, the earnings index rose 8.8% quarter on quarter and a mammoth 25% year on year. And this improvement has been fueled by far stronger growth in unit revenue compared to growth in unit costs. So the Container Terminal Revenue Index has been growing consistently over the past 8 quarters, and that was up 9% over the past year. Now, this has been supported by annual tariff increases, which were linked to inflation, but that takes time to feed through the system, but also due to an uptick in increased storage revenues. In some markets, we're seeing that storage revenues are moving up due to temporary demand surges in advance of the US tariffs, where we've seen an influx of cargo. But in other markets, it's more on the supply side, where the combination of blank sailings by carriers over holiday periods, strike action in ports and delays on landside transport have led to increased dwell times, and this generates additional revenues for container terminal operators. In contrast, the cost index rose by just 2.1% year on year, as inflationary pressures did ease last year in many regions. I think one thing to note is that the cost structure of the sector provides some protection against cyclical variations in volumes, but a steep downturn in activity triggered, for example, by the tariffs will definitely result in higher costs on a per unit basis in the worst impacted markets. I'll now take a quick look at deals and developments. So although Eirik has been talking about the big deal in the market, other companies have been out and active as well. In the last quarterly report, we took a look at our 3 latest entrants into our global terminal operator rankings. That's Adani, AD Ports, and Hanseatic Global Terminals. All three of these companies, having entered the rankings on the basis of their 2023 performance, have continued on really strong growth trajectories into 2024. Adani, which launched its Vizinjam International Port in 2024, has seen an impressive ramp up of volumes at this very first automated terminal in India, handling more than 0.1 million TEU every month now. And the performance has enabled Adani to sign a supplementary agreement with the Kerala government, which actually fast tracks the development of the remainder of the port and brings forward the date at which the Keralan government starts receiving revenue share from the operations there. AD Ports has signed an agreement in Egypt to develop and operate the KEZAD East Port Side Industrial and Logistics Zone, which incorporates a new multi-purpose port. Now, this aligns really well with the UAE government's vision to strengthen its political and economic ties in key regions, including Middle East, North Africa, but also links in with existing investments that the company's already made in Egypt, where it's steadily developing an integrated network of maritime linked businesses. And finally, we'll look at Hapag-Lloyd's investment in Le Havre CNMP. Our analysis of this deal sees it as a win-win. Hapag-Lloyd, which took a 60% stake in the terminal, uses Le Havre as a port, an entry port, for its shuttle feeder services, which link Le Havre into the Gemini mainline services. CNMP was the last remaining independent terminal operator within the port. So Gemini had a choice of either going to a CMA CGM control facility, an MSC control facility, or an independent control facility. By forming a partnership with Seafrigo, Hapag-Lloyd secured guaranteed terminal access in a relatively underutilized terminal, which will help it ensure that its shuttle feeders get the swift turnarounds it needs to support the Gemini schedule reliability. But for Seafrigo, they get a partner that's bringing volumes and also going to help them invest to improve the asset base at the port. So I'm now going to hand back to Dinesh for the key conclusions and start the question and answer session.
Eleanor, Eirik, thank you very much for sharing these key points from your recent research. Before I sum up the key takeaways, just a reminder, you can still add questions. We very much like to engage with our audience. If you're not able to answer the questions now, we will do so over email. Right, so on the plus side, Eleanor, what caught my attention was the sector earnings that seemed to be quite strong, performed quite well over the past year. Unit revenues remaining to be strong. The other thing that caught my attention was the portfolio growth, which will be driven by M&A activity for cash-rich carriers that are seeking to vertically integrate their ocean and landside networks. I think turning to the headwinds or the negatives, the impact of US tariffs policy, that remains a key concern. And the other question that it raises is, does all of this fundamentally change the competitive landscape for independent terminal operators? Right, we have about 10 minutes to answer, 5 minutes to answer questions that you have sent to us during the course of the webinar. Please feel free to add questions. We will, as we've mentioned before, we will be sending a recording of the presentation and a copy of the slides to registered participants. Let's have a look at some of the questions that have come to us. One of the interesting questions that has come through, Eirik, Eleanor, should competitor companies, terminal operators, be concerned at MSC's growth and market dominance in certain regions such as Panama?
I'll start with this one, if that's okay, Eleanor. it depends on the market, and it depends on what the shape of the final deal will be once the relevant competition authorities have gone through it with a fine-tooth comb. For example, the head of the Panama Canal Authority just day before yesterday came out saying he was deeply concerned about market concentration in the Panama Canal ports, and was concerned about what this meant for the competitivity of the terminals there. I think with all ports, there to an extent the terminal operators have naturally allied with their own customer base, and they provide a degree of logistics efficiency and networks which attract customers to their ports and terminals, whether or not they are a hybrid operator or are financially aligned with a shipping line. Having said that, the tie-up between now MSC, which is the world's largest liner shipping operator, and TIL and TIL operated MSC assets, which will, if this deal goes through, be the largest container terminal operator, should give all other operators pause for thought as to how they should adapt their commercial and competitive strategies to defend against what could be a significant risk to their underlying business.
Great. Thanks, Eirik. Eleanor, anything you want to add to that?
No, I think Eirik captured it all very well there. Thank you.
Great. Can I just ask then, Eleanor, you mentioned about the impact of the US tariffs or trade policy on demand. Beyond the impact on demand, do you think that the tariffs impact US port and terminal operators in other ways?
I think I think demand is the major impact there. So that's going to be the primary impact, and then combining that with the proposed fees on Chinese owned and built ship fleets, that impact on the US port sector in particular, not just containers, but across the port sector as a whole, is certainly going to be a very high risk to the US market, US economy. But I think if we narrow our focus back down to container terminal operators, the American Association of Port Authorities has already issued a very stark warning in relation to port equipment. And this Buy America, Build America, whichever way around it goes, has already been in the news, and they've been looking at this for a while. But by the time you look at the impact of what the proposed tariff would have been on a ship-to-shore crane and multiply that by the 4 or 5 you may be buying to expand your terminal or to replace existing equipment, then the impact of tariffs on terminal operator costs must not be underestimated. And I think it's important to note that in the current environment, there are a small number of alternative crane manufacturers, so Kona Cranes, Liebherr, which are located outside of China. But I wouldn't have said that the US policy is consistent or established enough yet for them to be putting in place investment plans to expand their production capacity. So I think for spare parts and replacement equipment in particular, US ports are going to see costs rise very, very steeply in the very near future, whatever the outcome. Tariffs are going up on this type of equipment and this type of imports. And the sector is one where those costs get passed back through to end users and eventually onto US consumers.
Thanks, Eleanor. Thank you very much. I must say, having you, Eirik, follow this market very closely, we are very fortunate as the advisory team to be able to draw upon the research that you do, but also on the intellectual capacity when you analyze these markets very closely on a day-to-day basis. To be right to say that at Drewry, the combination of research and advisory really comes into its own at times like this, because we are very quickly able to respond to our clients with in-depth insights and develop scenarios and iterations with extensive client base. There are many more questions we can answer. Unfortunately, we've run out of time. This now concludes today's webinar on Drewry's latest insights in the ports and terminal sector. We would like to thank you very much for your participation. If you have any follow-up questions, if you wish to engage with any of us, please do not hesitate to contact us by email using the email address on your screen, info@drewry.co.uk. If you would like to view and listen to a recording of this webinar, we will be posting a link to this on our website at www.drewry.co.uk. Thank you once again. We look forward to your participation at future Drewry events.
Thank you. Goodbye.
Thank you.